So with that, I'm pleased to get started. I'm Sarah Neiswanger, and on behalf of the National Glass Association, I'm joined by my colleague Lori Cowan, window and door editor, and we thank you for joining this month's Thirsty Thursday webinar, welcoming back Chris Beard of John Burns Research and Consulting. Before we dive into our topic, we just want to remind you, as we were just talking, Glass Build America is just 3 months away now. So we hope you're already on your way towards planning to join us back in Vegas beginning on September 23rd. Exhibitor registration is already open, and attendee registration actually opens 1 week from today on June 25th. So we sincerely hope to see you there. There are many new updates and additions taking place at this year's show, including a dedicated keynote theater and a new association row. So it will feature more of some of our parallel industry associations, including FGIA, the Fenestration Glazing Industry Alliance, the National Association of Home Builders, AIA, and several more. So please do join us and take part in some of these new initiatives we're planning for you. And with that, I'm pleased to turn it over to Lori, who will introduce our presentation.
Thank you, Sarah. I'm excited to be here today with Chris Beard. This is always one of our most well-attended webinars at the NGA. The industry is eager to hear all of the insights and updates on market performance and trends in this sector. Window and Door and the NGA have been collaborating with Chris and the team at John Burns Research and Consulting for several years now, producing the in-demand and essential window and door market survey quarterly. Chris is a regular speaker here on the NGA's Thirsty Thursday webinar series and at the NGA's Glass Build America, and his contributions frequently appear in Window and Door magazine. Before I turn it over to Chris, I do want to highlight a couple of big items coming out of Window and Door. First, we recently published our annual Top Manufacturers Report and List in Window and Door, which is a comprehensive industry ranking and market report for North American manufacturers of residential fenestration products. This year's report dives into market growth, products and materials, labor, automation, and what to keep an eye on in the industry. Secondly, we're currently putting together the Window and Door Awards feature, which is returning to print in our upcoming July-August issue for the first time since 2019. We're excited to announce this year's winners and celebrate innovation in the industry. Stay tuned. Third, if you're a Glass Build exhibitor, we want to hear about the products you'll be showcasing on the floor this year. Submit your products today for inclusion in the show issues of Window and Door and Glass magazine. We'll post the link in the chat. Now, without further ado, I'll hand it over to Chris Beard of John Burns Research and Consulting.
Thank you, Laura. Thank you, Sarah. It's a pleasure to be back with you since we last talked in March. Before we get started, I do want to mention that we have a QR code at the very end. You're welcome to screenshot some of the slides as I go through them today. But we also have a QR code if you'd like to download the slides directly. One of our team will be sending it out within the next couple of days. So with that, I'd like to kick things off. I feel like we're in 2026 and we can't really start any conversation in any industry without talking about AI. And so full disclosure, there was some AI used in this presentation, and it's the very next slide I'm going to show you. I said with everything that's going on in the market today, in the economy, in the world today, I asked ChatGPT, give me a great image that kind of symbolizes what's going on with homeowners right now and how homeowners should be thinking about the overall economy for the housing market. And this is what it came up with. Obviously, really tongue-in-cheek, a lot of joking here, but just kind of shows it's kind of symbolic of the overall chaos, if you will, and uncertainty that we're seeing in the market. So I want to kind of slice through a lot of that today and talk about many things that are driving how homeowners are thinking about the housing market and what that means specifically for the fenestration industry. So we're going to start off talking a little bit about the macroeconomic outlook, then we'll go into new construction and following a similar format as usual, go into R&R, what the drivers are then. Then we'll talk about the first quarter results from our Window and Door market survey that we do in partnership with the NGA and Window and Door magazine. And finally, we'll end with some opportunities and strategies and some key takeaways. So let's start with the macroeconomic outlook. The way we see it right now, headwinds are dominating so far this year. But I don't want to start with the negative. I want to start off more the positive tailwinds that we're seeing in the industry. Home equity is still near all-time highs. Labor market was remaining relatively surprisingly resilient. There's still about 24 million single-family homes in what we call prime remodeling years. So they're ages 20 to 39 years old. So they're ripe for larger replacement projects. Median household incomes are still rising. They're still, near record levels. And then we're still seeing strong demand in the move-up and luxury product segments. Those categories have remained relatively resilient, and we're still seeing growth in that. And I'm going to show several examples through our surveys and reports that we do at John Burns that highlights why we're thinking that. But nevertheless, there are some headwinds that we're seeing. Consumer sentiment, it's really at a 40-year low. It did tick up a little bit in May, but relatively speaking, it's still staggeringly low. Mortgage interest rates are persistently above 6%, so that's limiting existing home sales. And then, of course, tariffs and political uncertainty, they're suppressing builder and buyer confidence, as well as overall consumer sentiment. And then really since the Iran conflict, which hopefully is on its way to being resolved, they're really driving up material costs and increasing freight costs. And we're going to have some examples around that too. The way we see it right now, and you've heard me talk about this probably in the past too, is we see negative consumer sentiment really hindering new construction in R&R. And you can see this chart right here. This was the April reading. The preliminary reading for May did show a slight improvement, but this breaks it out by income terciles, by the bottom, middle, and then top tercile. And you can see, this time series goes all the way back to 1980, and we're at levels below that. And so we think even the negative sentiment of high income households remaining subdued is primarily impacting remodeling right now. Our forecast for mortgage rates, I said that we expect them to remain above 6%. This is kind of a year-over-year comparison from about a week ago. They are a little bit lower. We did have some expectations that rates would go lower when the president announced that he was directing Fannie and Freddie to buy back some mortgage-backed securities. Rates did dip below 6%, I say, for like a minute and a half, it seems like on a Friday. But they are a little bit lower, but not measurably. And our expectations for the coming years are for their 30-year fixed mortgage rates to remain above 6%. So that's a continued headwind that homeowners are facing, especially for those that are locked in at low mortgage rates, which we'll also talk about in a second. And then similarly, high diesel fuel costs. This is really since the Iran conflict. We all know the price of gas has gone up, although it is starting to retreat now. And then diesel costs, really important for trucking. And this is an example. This shows the residential retail diesel prices comparison of 2020 through this year. And you can see that dark blue line at the very top. We're touching levels that we last saw in 2022. And some commentary that we're seeing is, higher fuel costs are being passed on. Trucking companies are prioritizing more profitable loads. I hear from LBM dealers that I talk to every month, and they've been talking about fuel surcharges everywhere and also truck driver availability just because of the high cost of fuel. And that's something that's popping in our window and door survey too, which I'll highlight as well. So that's a true headwind. This cost is increasing and it has been passed on to consumers. Nevertheless, home equity levels were still near all-time highs in both total and per household, which is good news for R&R because when homeowners see that the value of their home is still increasing or at least being maintained, they're more apt to be investing in their homes. And so this is a comparison going back to 2000. You can see, and this is real equity and then real homeowner equity per household. So it's been normed out for inflation. And you can see that average home equity per household far exceeds the peak of the early 2000s housing bubble. So home values are maintaining their value. We do expect to see home values go up in the coming years. So that's good news, gives consumers confidence to be investing in their homes. And then this is the job growth that we've seen that has been reported by BLS. And I put in the headline, defying expectations. That really is defying expectations. We saw a significant decline in February, but the January, March, April, and then May prints have been exceedingly strong. And this really surprises us. Healthcare is a big driver of the job growth that we're seeing, but we're really surprised at the strength that we've seen for so far this year. And the reason why is our expectations for job growth. We expect softer employment growth this year. So our forecast is pretty anemic for the remainder of the year and in the coming years too, less than 1% job growth. And that's not necessarily a function of a softening economy or weakening of the economy or employers aren't hiring. It's more a function of population growth. And this slide is from our latest demographics report, which was released earlier this week. U.S. working age population growth is expected to slow by 99%. Yes, you read that correctly, 99% off of the 2010 to 2025 pace over the next several years. The reason for that is slow population growth. So fewer workers coming into aging into the workforce. We call working age population generally ages 18 to 65. So people coming into the workforce minus those retiring and exiting the workforce. And you can see relatively flat growth of employment throughout 2029. So this is a function of low birth rates, 18 plus years ago, as well as the changes that we're seeing in immigration policy and fewer immigrants coming in for the workforce. But because of that, inflation-adjusted household incomes are near all-time highs. So again, the weak job growth is not really driven by the overall weakness in the economy, but just by available labor. And because of that, we're seeing labor inflation. The window and door manufacturers that we talked to in our quarterly survey picked up on that too. We're seeing job growth, which is good news. If you're employed and you have a good job growth has been stronger. And that also helps offset some of the inflation that we've been seeing, especially since the Iran conflict. The CPI readings, the PPI readings have been higher. So despite broader affordability pressures that we've all talked about seeing in kind of the mid-tier housing, demand for high-end custom residential design remains strong. I'm not going to read through all the quotes here because you can see them, you can download them when I put the QR code up, but we're seeing strong demand from people with 1.5 million or more construction, strong mid to high income earners, modest growth driven by higher end clients. So this is just one example of a quarterly survey that we do with custom residential architects where they're saying real strength in that move up in luxury consumer. And while there has been talk about the K-shaped economy, in broader terms throughout this year and even at the end of last year, our analysis shows that this isn't necessarily true when we look at remodeling expenditures. So this is again broken up by income quintiles, lowest, second, third, middle, fourth, and the highest. And the chart on the left shows remodeling expenditures as a percentage of total by income quintile, and then on the right is based on home value. So the highest meaning the highest income earners, and then the highest value homes. And you can see this is from the American Housing Survey. This goes back to 1987. And when we dig into this data and look at it, the highest remodeling expenditures are, unsurprisingly, spent by the highest income earners and the highest home values. But you don't see a whole lot of movement in those bottom lines. So the share from the lowest even to the fourth lowest are not a whole lot of movement. So this really has been a story throughout, since this time series of 1987, that the highest income earners and the highest valued homes spend the lion's share of remodeling, but we don't really see a significant downtick, and we have not seen a significant downtick. So it's important to keep that in mind as we're thinking about the K-shaped economy and people talk about, discrepancies and maybe a bifurcation. We're not necessarily seeing that in remodeling, and I'd be happy to dig into that more if you'd like. So now moving to the new construction landscape. You've seen me show an example of this slide many times before. The blue area at the bottom are the number of completed yet unsold single-family homes. The green area in the middle are the single-family homes under construction, and the purple is permitted but not yet started. And you can see a percentage of total inventory. In that blue area at the bottom, at the very, very right, you can barely see it next to that arrow. We are starting to see an improvement or reduction, if you will, of unsold finished inventory. But I drew that line across for a reason. You can see, we're still 2009, 2010 levels of unsold finished inventory. One of the things that we do at John Burns that really helps set us apart is we have a monthly survey among other monthly surveys that we do, but one with home builders. And we capture roughly 15% of all new home sales each month. And this shows we ask a number of different questions around builder sentiment. But this is from our latest reading that just came out a couple weeks ago. Unsold finished inventory is coming down slightly. You can see all the way to the right is May 2026, and it's at 2.6 finished homes for community, roughly the same, a little bit lower than it was last year, but still well above the 2012 to 2019 seasonal unsold inventory average, which is the purple line, and then the seasonal average from 2022 to 2025, which is the orange line. So it's coming down a little bit year over year and month over month, but not significantly. But it is coming down because starts, what the builders are telling us, starts, single family starts have fallen to their lowest levels since 2011. And we got a housing starts report earlier this week, and in the headlines were that it widely missed consensus. But the builders in our survey have been telling that too. So starts are falling to what we're seeing in our survey, the lowest levels since 2011, and new home sales are slightly outpacing starts. So not by a broad measure, but new home sales are slightly outpacing housing starts, which is leading to a slow erosion, a slow whittling away, if you will, of that unsold inventory. Not enough to move the needle significantly yet, but at least it's heading in the right direction. And this is a longer time series of single family starts on a month by month basis. And you can see single family starts per community have fallen really every month since mid 2024. And so while production homes have been weaker, what we are seeing is some strength in custom home building. Again, tying back to that point I made earlier about move up and luxury home building being relatively stronger. This chart goes back to 1980, and this is the share of custom homes. And you can really see that solid blue line off to the right. You can see that inflecting positive. The share of total homes, total single family homes being constructed in the US, the share of custom homes is increasing. Again, pointing to that resiliency of that mid move up and luxury home buyer. Again, from our builder survey, I'll spend a couple minutes on this one, going left to right. The chart is the May 2026, our latest survey reading, new home price appreciation per our surveys. Builders are telling us that new home prices are falling by about 1.2%. If we look at resale home price appreciation, so existing homes and resale price appreciation, still positive at 1.8%. We have a single family market rental index that we do. We work with a lot of the single family rental operators. Rents are still growing there. Builders told us in the first quarter of 2026, again, this was largely before the Iran conflict, but they said construction costs have fallen slightly, relatively flattish, but they're coming down. But the big jump in that next circled area is lot prices are still rising. So builders are telling us that finished lot prices for them to develop to build new homes on these finished lots, they're still up significantly, up 4.1%. So you offset that with the new home price appreciation, which prices are declining, that's putting the builders in a little bit of a difficult situation. And I think many of you OEMs or on this call that work with primarily the production builders are probably hearing that and seeing that. Builders are talking about their margins being pressured, cost pressures with the use of incentives, finished lot prices. It's putting the builders in a little bit of a difficult situation. We ask quarterly, how are incentives shaping out? Obviously, incentives have been a huge driver for the new home market since interest rates started to increase in 2022. And nationally, incentives average 7.2% of the total sale price, which is up a little bit from 7% last quarter. And you can see there's variances across the country. Texas leads the nation. They're saying 10.6% in May of this past year. 10.6% of the total sales price is what the builder is contributing as an incentive to get that home buyer off the sidelines. And these could be in the form of rate buy downs. Primarily, it is rate buy downs, giving back of closing costs, also cash for optionality in the homes. And then contrast that with the Northeast, where the new home market is a little bit stronger. They're saying only roughly 3.3% of the total home price is being given in the form of incentives. So unsurprisingly, the three that lead at the top, Texas, Florida, and the Southwest, those are the markets that we're seeing softness in new construction. They're the softest markets right now, again, due to inventory and unsold finished inventory. So they're having to layer in these incentives a little bit more. So because of that, we look at the large builder gross margins, and they've really compressed down to 2020 levels. So the big run up in builder gross margins they saw during the COVID boom years, have been declining since the interest rates started to increase in 2022. And now, in the first quarter of 2026, we listened to all the public builders' earnings calls, and we're seeing the aggregate gross margins roughly back to 2020 levels. Why is that a big deal? Well, because in 2025, the public home builders delivered 48% of all new homes in the US. So the public production home builders have gotten larger. You can see this going back to 2003. And so this chart kind of breaks down the blue area towards the top is the public home builders. Their deliveries versus new home sales is a percentage, 48%. The orange areas are publicly traded subsidiaries. So these are publicly traded subsidiaries of major home builders. And then we have private builders with public debt. And you can see, all of that adds up to roughly, if you combine those three categories, roughly 60% of all new home sales are driven by these big builders. So when we hear margin pressure from the big builders, that is impacting the industry because of the sheer number of deliveries that they have each month. Again, from our monthly builder survey, this is a year-over-year comparison going from top to bottom. Direction of new home prices, you can see a slight improvement this year. 29% of builders this May said that they're actually having to decrease net prices versus 46 last year. Slight improvement in those that are increasing 10% versus 9% last year. But still, roughly a third saying that they're having to decrease prices net of incentives month over month. Traffic is also a little bit better, not a ton. So they're measuring traffic of prospective buyers coming to the homes, going into the model homes, kicking the tires, looking at the homes, showing interest. Still 38% are saying low traffic into their communities versus 43% last year. And then expected sales, roughly 10% of the builders say that they're expecting good sales, 70%, fair sales over the next 6 months, and then roughly a quarter saying they're expecting poor sales over the next 6 months. So this is kind of weighing on this. We don't expect a rapid turnaround, despite what we've been seeing around inventory being reduced. The builders are not really calling for a phenomenal year, and our housing starts forecast kind of reflects that too. We expect single family starts for the full year to be down for full year 2026 before we move into recovery 2027 and beyond. So let's talk a little bit now about the repair and remodeling drivers. One of the things that we've come up with that I don't think I've shared with this group before is we've established a proprietary remodeling index. And we look at 18 different data points. So some of it's from our survey data, some of it's retail sales. We do contractor surveys, home builder surveys, and remodeling contractor surveys. There's 18 different data points. We look at employment ratios or contractors adding employment, reducing employment, and we have a pretty sophisticated model. And what we like to show on this is this really is capturing inflection points because we update when the data is available. We update this on a weekly basis. And so we can see a deterioration to start this year. What this does, because of the real-time measure, and this is exclusive to our clients, I'm just showing it here for the sake of demonstrating, kind of where we can think about where we start to see some significant declines. No surprise, the GFC in 08, 09 started to see a decline in remodeling then. And then picking back up in the 2010 years, obviously a significant decline early in 2020 of COVID before it spiked back up and actually went off the charts. And this is a range from 0 to 100. The remodeling boom that we saw post-COVID is the strongest remodeling boom that we've seen in this country, and we've since deteriorated when interest rates started to increase in 2022. But this will capture, and this also captures slight improvement that we saw at the end of 2024, where we thought like, okay, it's starting to be a rebound, and then with the macro headwinds that we started to see beginning, we'll call it early to mid 2024, things have deteriorated. But what this is going to capture is we're going to capture some inflection points. So when we see the market start to move up a little bit, that's when we're going to become more optimistic around the remodeling industry. But we're not seeing it just yet. Another thing that we look at too is we track remodeling with overall consumer expenditure. And this again shows our remodeling index from the prior page. That's the 2-quarter average. That's the dotted blue line. And then you look at real consumer expenditures is the left axis. And you can see, the remodeling index and expenditures went up during the pricing shock, the inflationary period that we saw post-COVID. but they generally track along with each other. But since 2023, remodeling is tracking below what we would expect for overall consumer expenditures. So some of the reasons for that are overall weakness in housing, including new home prices, new construction, and existing home sales. Also, outsized growth in building products pricing versus other consumer products. So building materials pricing, generally speaking, is up 40% over 2019 levels. That's more than the broader inflation that we saw in other household goods. So that led to sticker shock in remodeling activity, consumers saying, whoa, I didn't realize it was going to cost that much, so pulling back. And then really consumer uncertainty, it's weighed the most on bigger ticket household relating spending, just that overall macro uncertainty. We look at when do homeowners typically spend money, and this is kind of broken out by age bracket. And really no surprise, between the ages of 35 and 44 and 45 to 54 is when the bulk of remodeling spending happens. It's when people are better situated in their careers. They may be moving into a move-up home, have a little bit more disposable income. And so this is where we see the age brackets of when people typically will spend more on remodeling versus other age cohorts. And the good news is through 2028, we do expect a pickup in households in these what we call peak discretionary remodeling ages. So this again is work from our demographics team. One of the good things about demographics is it's relatively predictable, minus some of the wild cards like aging and immigration. But somebody who is 40 years old today, we know was 30 years old 10 years ago and will likely be 50 years old 10 years from now. So it's relatively predictable to see when these households are moving into these age cohorts. And you can see obviously the big spike in the 65 to 74 and then 75 up. Those are obviously the big boomer population. But we're starting to see more of the millennials and households moving into these peak discretionary remodeling groups. So that is going to be a tailwind for the industry in the coming years. Again, once consumer sentiment starts to improve. Home buying activity, really the lowest that we've seen in decades. So existing home sales are a driver of remodeling, especially some of the bigger ticket replacement projects. This kind of walks us through going back to 2004. So pre-GFC, roughly 7 million existing home sales a year. Then the GFC hits, we go down to about 4.1 million existing home sales a year, slowly trickles back up to 2021 where we got to 6.1 million existing home sales. And then interest rates crept up in addition to people being locked into those low mortgage rates. And now we're back down to 4 million existing home sales a year. That's a pretty significant drop. Our projection for 2026 is a slight improvement over last year, but last year was terrible. The year before that was terrible as well. But that's a significant drop in existing home sales. That's important because we've done some analysis on this too. And existing home sales drive bigger remodeling projects at roughly a 2-quarter lead. So a home transacts. Roughly 2 quarters after that is when we start to see a significant increase in remodeling activities. So, which makes perfect sense, right? People move into a new home and they get settled, get their stuff moved in and say, well, I really want to do this. I really want to do these projects. I think many of us have been there. It's roughly 2-quarter lead. So when we do start to see an inflection point, when we do start to see existing home sales tick back up, that's when we expect remodeling to improve as well. We've shown this slide before too, but this is the latest reading. Homeowners are continuing to be locked into really low mortgage rates. Roughly 20% of all outstanding mortgages in the US are below 3%. Another total of 51 are below 5%. 68% of all outstanding mortgages are below 5%. And then I'm going to circle this area at the top. 21% or 22% rather have mortgages above 6%. And obviously the prevailing mortgage rate right now is above 6%. For a couple of obvious reasons. Number one, homes have transacted in the past several years, since 2022. So people are undertaking new mortgages, getting in that 6% rate. So you're seeing movement in that purple area at the top above 6%. You're seeing some movement in the yellow, green, and orange areas as a percentage of total outstanding mortgages. But you're not seeing a ton of movement in that blue area at the bottom. That line has remained relatively flat, share of roughly 20%. And the reason is If you have a 3% mortgage, it's going to take a whole lot of motivation to really give up that mortgage and take on a new mortgage by moving. So people below 3%, they're going to stay in their homes as long as possible. So that could be a tailwind for remodeling, but if you're thinking about it from an existing home standpoint, it could also be a headwind for remodeling. So I just think that's important, the context, to see how this is flowing through time. And I think it's very interesting to see, people that are refinancing, people that do have mortgages below 5 and the 4s too, that share has shifted. We've done considerable research on this. We have a consumer research arm with our New Home Trends Institute. And what consumers overwhelmingly tell us over the past 3 years is 5.5% is what we call the magic mortgage rate, if you will. That's when consumers tell us that no matter what their situation is right now with whatever mortgage rate they have right now, 5.5% is roughly when consumers say that they're willing to consider taking on a new mortgage and moving. This could be renters that are renting right now and say, okay, when the rate gets to 5.5%, it's finally palatable enough for me to take on a new mortgage and move, but also existing homeowners that have low mortgage rates. And as I showed earlier, we're not expecting rates to be below 6% anytime in the foreseeable future. So for an existing home sales standpoint, that is going to continue to be a headwind. We do a quarterly survey of remodeling professionals. This is in partnership with Qualified Remodeler Magazine. And we ask things like, what do your backlogs look like? How many inquiries are you getting? Lead times, et cetera. And so we do a diffusion index. It's similar to our window and door market index, 0 to 100. Anything above 50 typically signifies an expanding market. Anything below 50 is a contracting market. And interestingly enough, in the first quarter, they told us that every region of the country was expanding. Obviously, this varies by degree of remodeling exposure, and we'll talk about that here in a second too. But I want to draw your attention. You remember what I said in the new housing market, Southwest, Florida, and Texas were the weakest. The builders there were having to layer on the most incentives. But you look at the Southwest and Texas, those are the strongest regions for remodeling. So again, it goes back to number one, people being locked in their homes, locked into those low mortgage rates. The new home market, even though prices are coming down, builders are having to layer on incentives. Remodeling in these areas is the strongest. It's the weakest in the Northwest, but even the Midwest and Southeast is showing some strength. And then contrast that with what we saw in the Northeast, builders were using the lowest levels of incentives. And that's one of the weaker markets for weaker parts of the country for remodeling. So really interesting to kind of see the regionality of this. We ask about inquiries. We've asked about this throughout our survey's history. Are you getting more project inquiries than normal? That's the green, kind of the normal pipeline, normal people kicking tires and asking about projects is the gray. And then the red is fewer project inquiries than normal. The number that said fewer than normal, and again, normal is relative. We don't really ask them to define that. They can kind of use their own terms. That did come down sequentially, 42%, which we haven't seen those levels since the first quarter of 2024. So that's good news. 28% said more projects inquiries than normal. So actually, things are kind of thawing, it seems like, a little bit. And then when we look at win rates, this is interesting. This kind of breaks it down by the 3 different remodeling categories that we survey. We survey design build firms. Those are the big, soup to nuts designing, and then have professional construction crew coming in and doing the bigger work. Full service remodelers, they're doing similar, but maybe have design services. Maybe they work with an outside architect. And then home improvement pros, generally speaking, they're the smaller ones. Can somebody come in and hang a door for you or replace maybe 1 or 2 windows. But they're generally smaller projects. And you can see from the first quarter, from the fourth quarter, we started to see they reported win rates coming back up. And here's a representative quote that I included on here: fewer leads, but better quality. Homeowners still want to do the work. There's just fewer of them. So inquiries maybe get a little bit better, but the win rates, people that I think what that tells me too is people are finally coming to grasp with the project costs, how much it's going to cost. And they're saying, okay, this is roughly in line with what I expected. I've been sitting on the sidelines for too long. I'm ready to do it. We think there may be a sense of FOMO kicking in. People have just been sitting in their homes, realizing that mortgage rates aren't going to improve. something else is going to come along that's going to disrupt things. But you know what? I'm living in my house. I feel okay about my job situation. My home's still appreciating in value, have tremendous equity built up into it. So okay, I'm just ready to move forward. One quarter doesn't make a trend, but I do think this inflection point is kind of interesting to look at, and we'll see how things progress in the second quarter. We also asked to, you know, especially since we saw the materials inflation predominantly in 2020, 2021, are a higher percentage shifting to, is there a noticeable shift in people trading down in product quality? No noticeable shift in product grade or price points, and then consumers shifting to higher grade or higher, so trading up in material. And you can see the larger percentage is still homeowners trading down. Said, yeah, I may have wanted that wood window, but I'm going to go with a vinyl because it suits my need. It's a lower price point, and I can make some compromises here. Could be you know, LVP instead of hardwood flooring, for example, or vinyl siding or composite wood siding versus fiber cement. And you can see the representative quote I included on here. Higher end clients still tend to navigate into better quality, but the mid-range has been far more price conscious, choosing to do fewer areas and select more budget-friendly products. This is generally speaking, we asked them this about, you know, overall the projects that you're doing, more trade ups versus trade downs, but it really varies by product category. So I thought this is really interesting. And I highlighted two areas on here specific to the fenestration industry. The windows is the highlighted area on the left, and to the right of that in doors. Contractors told us, remodeling contractors told us 15% of them said there's, yeah, more people are trading down, but a higher percentage, 21%, say no, they actually are shifting to higher grade price points. So, you know, their windows is a category where say, you know, I actually do want to invest a little bit more money and spend on that. Doors, same thing. 11% say more trade downs, so maybe hollow core interior doors versus solid core. But 15% say, you know, there's actually more trade ups. I'm seeing more trade ups. So, kind of just to complete the narrative here, you can see, you know, by and large, people are saying they're not really a noticeable shift across all of the different product categories, but there are nuances. You think about, you know, kitchen appliances is an area I didn't highlight here, but 30% of the contractors say no, they actually do want to trade up for those updated features, versus 18% saying that they want to trade down. Conversely, cabinets, 22% said that, you know, people are down, they're trading down in the cabinets versus only 16% trading up to nicer materials and nicer finishes. So I just think it was very interesting to see the differentiation across the various product categories, but windows and doors seems to be more of a trade up category. We asked this since 2022, what is the main bottleneck to growth over the next 6 months? What are the things that's really what you think is the biggest challenge that you're seeing? And 51% said in the first quarter, consumer uncertainty. That's what they hear over and over. Not really sure where the macro is headed, not really sure what's going on with the labor market, with everything that's been going on. Think back to that first slide that I showed, the chaos that we're seeing. Consumer uncertainty, consumer sentiment being low, people just pulling back and saying, I'm just going to wait. Once we start to see an improvement in consumer sentiment, is my firm belief is when we're going to start to see a big unlock of the remodeling that we're expecting. And here's a quote, you know, consumers are still doing work, just making more modest remodels, taking longer to get through the sales cycle, citing economic concerns as the reason for the delay. We're seeing, interestingly, you know, second is building material costs. So cost increases are still coming through. But the third is also skilled labor shortages. So think about that working age population growth slide that I showed earlier. There, you know, 33% said that's the biggest concern. I just don't have enough people. I don't have enough skilled labor to actually get all the work done that I want to have done. I've heard this from remodeling contractors over and over that this is a real problem, and that lack of working age population growth is going to be, in our opinion, a headwind going forward. We see the impact of tariffs taking a diminishing role. One of the things that I ask in our monthly dealer survey, we talk to pro dealers every month, and we say, you know, what's the biggest concern? Is it labor availability, which is generally the highest concern for them? Is it unsold inventory? Is it price increases? And for the first time since we started asking about tariffs in early 2024, no dealer said that they're really concerned about tariffs. Even though the situation's fluid, you know, we've had some decisions and then Supreme Court decisions that overruled things too. But now we're coming into July when we expect to see Section 122 tariffs rolling off and Section 301. Can't keep up with all the numbers. It's a fluid situation, but it seems like the industry is relatively, I won't say callous to it, but that's kind of the term that I mean, just kind of getting immune to all the tariff discussion. And it is what it is. But consumer uncertainty is still the number one barrier to growth. When we say, when remodeling customers, so homeowners, how are they saving money? You can see first quarter 57% said they're down trading in material quality. 47% said it's brand reputation, durability, lifespan. So this is what the remodeling contractors are telling us, what they're doing with the compromises that homeowners are making to still be able to fulfill their projects. And then this is interesting. We asked latest one of our questions of the quarter was around contractor arranged financing. When do people actually, how many contractors are offering it and what product categories are benefiting the most from it? And I thought that was relatively interesting to this audience. Windows and doors led all categories where they're saying, contractor arranged financing or, maybe a credit card in the form of a third-party financial credit card to offer financing. That seems to be moving the needle the most in the windows and doors category, with 20% roughly of respondents saying, like, yeah, that's 20% of my homeowners are actually using some of this arranged financing. So when we get to the takeaways, I'll refer back to that too, but kind of keep that in the back of your mind. If you think about the different projects and what's important for the fenestration industry, contract arranged financing seems to be a big deal. So now I'm going to go into our quarterly report that we do with Window and Door Magazine, the first quarter results. Just as a background, this is a exclusive partnership between Window and Door Magazine and John Burns Research and Consulting. It is a quarterly survey of residential manufacturers, glass shops, glazers, and installers. So we do limit this to residential. We don't tie into commercial. But Sarah, Lori, and Katie and I have been in discussion of how we can maybe extend that further into the commercial space. But right now, we're only going to talk about the residential market. We do measure things of volume, revenue, lead times, backlogs, supply chains, other further guidance. And what I like about this survey too is it's quantitative data, so it's strictly numbers. My orders were down 3%, up 10%, whatever that is. But also the qualitative commentary that we use to really help derive sentiment. And that really gives us a nice vibe of the industry. If you'd like to take part in this and you don't already, first of all, thank you to those that do take part in this every quarter. We do have a very nice representation, but we're always looking for more. My contact info is at the end too. If you'd like to take part in this and be part of this, which will also give you the survey results too. It's kind of you'll get the full report as a thank you, as well as a local market report that we give too. You can reach out to me. We'd love to have more in this survey. So getting into the results, this is the first quarter results. So we published this a couple of weeks ago. Companies did report a continuation of volume declines to start the year. And this is a time series going back to the first quarter of 2024. And they said in the first quarter, and you can agree or disagree with these numbers, we're strictly reporting what the manufacturers told us. One thing I didn't mention about the survey too is it's completely anonymous. So I can't track back who said what about who or what the market was. We don't use any manufacturer's names. Coming from this industry, I know how private it is, how close people like to keep things to the vest. So we can't quantify like, oh, well, manufacturer X said this, manufacturer Y said that, and there's no competitive advantage. We keep that completely anonymized. It's in a black box. So what we do is we take the overall net average. And because I can't weight average it based on revenue of the company, simply for that purpose, we think the confidentiality, anonymity is more important to the industry and more relevant to achieving the kind of results that we're getting. So what manufacturers told us in the first quarter was volumes fell by 1.4%. And what I can say is we have a decent mixture from entry level to kind of the move up manufacturers in this space. 36% said volumes declined on a year-over-year basis, and versus 18% saying they increased. And you're seeing volume declines throughout much of 2025. No surprising. Third quarter actually came in a little bit stronger, gave some optimism, but things ended the year then pretty soft. When we ask about backlogs too, companies noted slightly higher backlogs. So 27% said backlogs actually increased year over year versus the first quarter of 2025. But then another 36% said backlogs are actually decreasing, compared to 67% said the year over year in the first quarter of 2025, 67% backlogs decreased versus the first quarter of 2024. We ask about overall strength of segments by multifamily, single family repair and remodel, and single family new construction. And in the first quarter, the call out here is nothing's jumping off the charts. Nothing is showing really strong demand, but single family R&R is showing a little bit more strength in the first quarter of this year than it did last year, versus multifamily, single family new construction, kind of the same, really the weak demand environment. So again, R&R is a little bit stronger, but again, nothing significant. Here is another inflection point that I'm waiting for. When I see these numbers jump, then that's when I'm going to give me more confidence to say that we're approaching recovery in all three of these segments, but we're not seeing it just yet. This is the slide that kind of concerns me. So we ask about direct labor costs, year-over-year change in direct labor cost, and year-over-year change in material costs. And the blue line is the material costs, and you can see really going back since the tariff announcements, we've seen an acceleration of material costs. 7%, 8%, highest reading in survey history, was 8% in the third quarter of last year. I think that's when a lot of the tariff stuff was flowing through, but still at elevated levels. Direct labor costs, again, what I was talking about earlier, not a huge growth in labor job growth and available labor. So direct labor costs are also increasing. And here's a representative quote that we got: cost increase and interest rates are hurting the business. Tariffs and political instability are the main drivers. So this is really interesting to see from a cost perspective. How are companies thinking about things? How are their overall business operations functioning? And then we also ask for guidance too. We ask for full year shipment expectations. One of the things we ask is quarter over quarter, and then for full year. And this is an expectation of 2025. So what folks told us last year, in the first quarter of 2025, they expected shipments to increase by 3.1%. And shipments actually decreased for the full year of 2025. Again, based on our survey, down roughly 1%. I think the industry was down more than that, but that's what came back in our survey. But you can see diminished expectations for this year, the area on the right. Only 36% of companies said they're expecting higher shipments this year than last year. And again, last year was not a great year necessarily for shipments, but also the expectations for full year shipment growth have come into. So they're expecting about 1% increase in shipments for full year 2026. That again may prove to be a little bit overly optimistic. So this is why we track this on a quarter by quarter basis and see how the sentiment changes as we move through the year. But this is what the industry was thinking in the first quarter. And then we say, what about revenue? So shipments are one thing, but we know that there's been price increases due to the increase in costs. And so 55% say they do expect higher revenue for full year 2025 or 2026 versus 2025, but the expectations are really muted. So they're saying 0.3%. So contrast that with 1.1% increase in shipments, but only 3.3% revenue growth. That tells us that the industry is expecting price declines, because otherwise you would see at least that in the volume growth translated to revenue growth. And companies are just not expecting that. Last year, they said they thought revenue would be up by about 2.5%. And what it came in at the end of last year was 1.8% for full year 2025. So pretty weak growth from a shipment standpoint, volume standpoint, and a revenue standpoint. But still elevated levels of costs, which is leading to the next question that we ask: what are the main focus areas that you're thinking about over the next 12 months? If you had to pick one thing that your company or organization is thinking about, what is the number one thing? And roughly a quarter of them say production automation. We've seen this really since last year. What was interesting is when we first started asking this in 2023 and then in 2024, we started to see energy efficiency and code changes be the main focus area, as there were incentives, as some regulations were coming through from in various municipalities and also from the federal government around code changes. That became the number one focus area. But really, production automation has overtaken that, with roughly a quarter of the respondents saying that is the main focus area. because of the cost increases, right? So labor costs are going up, material costs are going up. We need to become more efficient in our production. And then 20% roughly saying footprint expansion, new production facilities or new markets, and then some of the other categories. We ask each quarter some unique questions, and this next question was really around tariffs. We said, did you pay tariffs last year? And the Supreme Court overruled the tariffs collected under IEEPA, and the Court of International Trade said, yep, all the tariffs that were submitted have to be refunded. There's been some challenges with the federal government. But I thought this was really interesting. And the precipice was I was in another conference, or the what prompted this question was I was at a conference for another industry association a few months ago, and I said, "Well, you guys paid a bunch of tariffs, and you're getting them all back." And I heard overwhelmingly people say, "Yeah, probably not." And that really surprised me because they said, we really don't want to kind of poke the bear, and it's kind of a sunk cost. We've already paid them. Yes, we could get refunds. And then I did see the administration come out and say, we're kind of keeping track of who's asking for tariff refunds and who's not, and we're paying attention to this. So this is what prompted this question. We asked, as a manufacturer, did you end up paying tariffs? And of those of you that did, are you going to be asking for these refunds? And so this kind of surprised me a little bit. 55% of the respondents said, yeah, we did actually have to pay tariffs last year, but only 33% said they're actually going to ask for these refunds, with another 50% saying, unsure or don't really know. So I thought this is really interesting. 17% of those that paid tariffs said that they're not going to apply for the refunds. Just let it go. So I thought this is a really interesting take and kind of the sign of the times of where we're at right now. And then we talked about cost increases. So we say, are you planning on reducing or streamlining your product offerings? So costs are going up, very complex SKU basis maybe. Are you thinking about simplifying? And interestingly, 82% said no, we're going to kind of push forward and go with the SKUs that we have, not really thinking about streamlining our operations or our product offerings. And then here's some of the qualitative commentary that we've got. Again, I couldn't see who said this. This is all anonymous, but we do see the direct quotes. On market conditions, tariff and political uncertainty killing demand, consumer developer confidence extremely low, projects aren't penciling, new construction's way down, people are staying in their homes and spending money, especially with low mortgage rates from 2021. Again, that lock-in effect that I talked about. Competitive strategy, market is relatively flat. We really have to take care of our customers extremely well to win because the market is so intense and so fierce right now from a competitive standpoint, really focusing on that, working to increase partnerships, grow our dealer base to serve this segment. And then finally, despite rising costs, finding ways to pass on costs to consumers. Homeowners are desperate to replace problem areas in their homes. And then seeing weaker demand, tariff and material input costs are driving up costs. Material input issues are driving up costs. So now we've got a few more minutes. I'm going to go through some opportunities and strategies and really what we think is important for the fenestration industry this year and next. First is prioritize R&R over new construction. So we have, as I showed earlier, R&R is a little bit stronger. Homeowners trapped by the mortgage lock-in effect are investing in their existing homes, albeit at lower levels than normal, but it is stronger than the new construction market today. The luxury and premium and move-up segments are showing better backlog trends. These buyers are less rate sensitive, less sensitive to overall cost, and are still actively investing. We're seeing that continuation happen as we've moved through this, high cost environment. Those consumers are still investing, so we think that's a opportunity area. Expand contractor financing programs. I spent some time on that slide. That windows and doors have the highest share of contractor arranged financing of any category. These financing programs are converting leads into sales in a cost-sensitive environment. We do think investment in production automation. We don't think material costs are going to come down anytime soon. We certainly don't think costs for labor are going to come down anytime soon, again, for the reasons I discussed around working age population growth or lack thereof. Efficiency gains now are going to pay dividends in the recovery. And then capturing market share aggressively. Invest in sales and marketing resources now to grow as the market turns, which we are expecting to happen next year. We think it's great to position for a 2027 new construction recovery. all markets are going to return to growth in 2027. So maybe fortify builder relationships, get products spec now when the competition is a little bit lighter. So even though my first bullet said prioritize R&R over new construction, we are expecting that turn in new construction to happen next year. So it's important to be thinking about that now as we're almost halfway through this year. And then finally, some key takeaways. We think the market's soft, but it's not collapsing. The overall market index was at 48.4, just below neutral. Revenue is up very slightly despite volume declines. It is challenged, but it is still functional. We're not in a collapsing market from our vantage point. R&R is the bright spot. New construction is a challenge. R&R demand is a little bit stronger, as I showed earlier, and slightly improving year over year. New construction demand isn't going anywhere relatively quickly this year, below the 3-year average. But again, as I mentioned, the turn we're expecting next year. We think that there should be a little bit of a sequential improvement this year. Expectations for the second quarter were higher than for the first quarter, but we think that seasonality and replacement demand should provide a little bit of a boost in the second and third quarters. And then cost pressures, they're not going away. As I mentioned, materials up, labor up. Pricing power does not exist too much in new construction from everything I've been hearing, but it does slightly in R&R. Companies are not expecting to fully recover all costs in this demand. So investment in automation, production efficiencies are key to helping bring down some of those costs. And again, we think 2027 is going to be the recovery year. Positioned for it now. We expect all end markets to return to growth now, invest in market share capture today, and all the other things that we talked around about building builder and contractor relationships. That's going to help you win when we start to see the turn. So with that, here is the QR code that you're welcome, and my contact information. You're welcome to download. Just snap a picture of that. I think the team is going to send out the deck also. If you would like to participate in our quarterly survey, you can reach out to me directly or fill out the form with the QR code. I'll leave this up for a few seconds and then turn it over to Lori or Sarah to see if we have any questions.
Chris, thank you so much for this really informative presentation. We have a great picture of what's happening in the market and fenestration in particular right now. So I really appreciate it. We do have a couple questions that have come in. The first one is, what is the current mortgage rate?
The current mortgage rate, 30-year fixed, I believe I saw was around 6.5%. Fannie or FHA was 6.2% earlier. I believe earlier this week when I checked. I didn't look today or yesterday, but it still is above 6%.
Okay, thank you. Another question. Aren't taxes also a lock-in contributor since home values have increased faster than tax basis, meaning moving to an equivalent home means not just higher mortgage rate, but also higher taxes?
Potentially, and this varies across the country. So I live in Iowa, for example. I lived in Ohio before. The county was always really good about coming by and assessing the value of your home and increasing your property taxes proportionately. So, but then I also heard there's other regions which kind of blew my mind. I think it was California that said that your tax base and what you pay in property tax is based off the purchase price of when you purchase the home. Don't quote me on that. It's something I heard. So I think it varies across the country. Most region that I've seen is you do get a new assessment for your property value based on current market conditions, at least every couple of years. I know that's been my case since I've been a homeowner, and I think that broadly speaking, that's the same. So I don't think that's necessarily a tailwind of people staying in their homes, because I think that tax assessment value does change.
Okay. What does production automation mean, and do you have any examples?
Oh, we can spend a lot of time on that. I think it's, as I think many of you on the call know, window manufacturing is pretty labor intensive. You've got a line and you have to have a lot of humans to show up on that line to make a window. It's a very manual process still traditionally. There have been some strides in some of the automation, meaning, automatic glass setting, could be some, framing that takes place by automation. A lot of different examples. We don't ask specifically, what do you mean? And that may be a good question next quarter, like what examples of automation are you seeing? We do expect, like, through AI becoming more into the industry and manufacturing, to see some advancements there. quite honestly, in home building, particularly, we're not seeing a ton of automation yet with the on-site construction. But I think, streamlining some operations, even if you can get, one or two less humans per line to make a window, that is going to help save some costs. But yeah, we can dig into some real world examples, I think, next quarter.
It's a great idea. Um, the data shows that windows and doors are more of a trade-up category for consumers. Do you think that has to do with performance, with efficiency savings, or something else altogether?
I think it's probably driven by performance, which I'll lump in performance with efficiency. I think efficiency is kind of table stakes, honestly, but also aesthetics. Just aesthetically, what's going to look nicer. And there's been some great strides when you think about the various material types with bigger sight lines and fewer, smaller frames, maybe in the composite or fiberglass category, to actually, increase and strengthen the frames, allowing more glass in the opening. I think aesthetics is a big driver too.
Well, thank you so much, Chris. I think that takes care of all of our questions, and we are also at about time for this afternoon's webinar.
Thank you so much. Pleasure to be here.
Of course, thank you. We appreciate it. We hope you'll consider joining us for some of our upcoming webinars. Our next one is on July 16th at 1 p.m. Eastern about its hurricane season once again, testing and certification for building products. And then if you're a member of NGA, we hope that you'll consider joining us for our new member open house, so you can meet the team and bring your questions about all of the benefits of membership in the National Glass Association. Thank you very much.